The Bank of Canada just warned about consecutive rate hikes for the first time, and bond market's already pricing a 94% chance they follow through by October. But here's the problem nobody's talking about. Hiking rates doesn't fix a gas price shock. It just breaks everything else first. Welcome to the Daily Brief Canadian Macro. I'm Steve. Today we're covering the Bank of Canada's dramatic shift in messaging, with two creators breaking down what Macklem actually said and what it means for Canadians carrying $1.71 of debt for every dollar of income. Market Mania on the hawkish shift, Mark Mitchell on the fine print, and then we're going to push back on whether rate hikes are even the right tool here, because we don't think the consensus is asking the hard enough question. Market Mania covered what they're calling a massive warning from the Bank of Canada, the first time the bank has explicitly put consecutive rate increases on the table. The fuel for the alarm is real. Gasoline futures up over 80% and diesel up 70% since the Middle East conflict escalated, with oil surging 7.2% in a single day. What makes their analysis particularly sharp is pointing out that rates are already rising without the bank doing anything. 6-month bond yields are up 16 basis points since March 18th, while the policy rate hasn't moved. That last point is worth sitting with for a moment because it connects to something bigger happening in the Canadian bond market. The yield curve right now is undergoing what's called a bear flattening at the front end. Short-term yields are getting dragged higher by rate hike expectations, while longer-term yields are already elevated from fiscal concerns and deficit spending. When that happens, it signals that markets have essentially lost patience waiting for the central bank to act and are moving ahead of them. The dangerous version of this scenario is if the curve then steepens sharply at the long end too. That's the bond market saying it's worried about both inflation and the government's ability to finance its debt. We're not there yet, but the direction is worth watching closely. And with 52% of Canadian mortgages renewing by end of 2027, every basis point the market moves independently of the bank is costing Canadian households before a single official decision is made. Mark Mitchell's take focuses on the conditional fine print in Macklem's language. The hold only survives if oil comes back down and U.S. tariffs don't escalate, two variables completely outside the bank's control. Mitchell flagged that Macklem leaned on the word consecutive multiple times, but gave no timeline for when oil needs to cooperate. Mark Mitchell also caught something that mainstream press missed entirely. The bank dismissed questions about $16 billion in daily repo market injections that started in late March, with officials pushing back on the word dislocation. That matters because repo market stress, when banks need that volume of short-term liquidity from the central bank on a daily basis, is typically a sign that something in the financial plumbing is under pressure. It doesn't necessarily mean crisis, but it's the kind of thing a central bank usually addresses directly, not waves away with a semantic objection. The fact that officials chose to dispute the language rather than explain the mechanics should raise an eyebrow. And when pressed on COVID inflation lessons, Macklem pointed to supply chains and geopolitical conflict, not once mentioning money supply expansion as a contributing factor. That's not an oversight. The Bank of Canada dramatically expanded its balance sheet during COVID through quantitative easing, and acknowledging that as an inflation input creates accountability for the institution. Mitchell noticed the omission. We think it matters because a central bank that won't account for its role in the last inflation cycle is much harder to trust when it tells you this one is purely external. Here's where we part ways with the consensus. Everyone screaming rate hikes right now is treating this like a demand-driven inflation problem. It isn't. Energy demand is inelastic. People aren't driving to work because interest rates are low. They're driving because they have to. You can't hike your way out of a Strait of Hormuz closure. What rate hikes actually do in this environment is accelerate the stress that's already building. The Canadian consumer is already squeezed, elevated food prices, mortgage renewals coming at higher rates, a labor market that shed 110,000 jobs in early 2026. Higher rates don't bring oil prices down. They just ensured that the spending that was holding the economy together, discretionary retail, restaurants, home renovation, travel, gets cut first. You end up with the same energy inflation and a weaker economy underneath it. The bank knows this. It's why Macklem's language was deliberately two-sided today. Hikes if oil stays high, cuts if CUSMA goes badly. That's not confidence. That's a central bank strapped into the passenger seat at a railroad track watching two different trains approach at the same time. The question nobody asked Macklem today, Governor, if hiking rates can't reduce oil prices, and hiking rates will further damage an already stressed economy, what exactly is the transmission mechanism you're counting on? What breaks first, inflation expectations or the economy? We're betting it's the economy. Both creators identified the same pivot. The bank has moved from neutral hold language to explicit hike warnings. Bond markets are already moving, but the framing of this as a straightforward inflation fight misses the structural reality. This is an energy price shock hitting an economy that is already soft. 1.2% GDP growth, 6.5 to 7% unemployment, households carrying historic debt loads. Rate hikes in that context don't tame inflation, they tame spending. And when spending is already one of the only things keeping growth positive, that's a much more dangerous trade-off than the consensus commentary is acknowledging. Market Mania is right that government relief spending risks adding fuel to the fire, but the cure being prescribed, consecutive hikes, carries its own serious risks that aren't getting equal airtime. Well, that's your daily brief for today. All credit goes to the creators featured. Their original analysis and videos are linked in the description below. If you found this video helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator or topic you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.